Let's talk about NIIT, Net Investment Income Tax, on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today we're talking about NIIT, Net Investment Income Tax. So kicking things off with NIIT here, Net Investment Income Tax. Pretty much just think of it as it's an extra 3.8% tax on passive income for taxpayers who are above certain income thresholds, okay? 3.8% tax on passive investment income that applies to taxpayers who are above certain income thresholds. Okay, and we'll dive into all that here in a minute. As far as the history of NIIT took an effect in 2013, and Congress enacted the NIIT in the Healthcare and Education Reconciliation Act of 2010, and it was part of a broader Affordable Care Act package. The purpose of why it was instituted was to raise revenue from high-income households that earn significant investment income, functioning to help finance healthcare expansion. Okay, so it's introduced in 2013. It was introduced in 2010. It was implemented in 2013, and it's just part of the Affordable Care Act. It's there to raise revenue from high-income households through this net investment income tax. So NIIT does apply to estates and trusts, but for our conversation here, we're pretty much focused on individuals. Okay, so let's dive into it. So NIIT, like I said, we're focused on passive income. Now, we'll get into the calculation and an example, but you pay this 3.8% net investment income tax on the lesser of the amount that you're over the modified adjusted gross income threshold or on your passive income. Right? That's how the calculation is. We'll talk about that later. But it's important to talk about what is passive income, what is ordinary income, right? What is earned income, I guess you could say. Okay, so things that are passive income, some examples: ordinary dividends, taxable interest, capital gains, right? If you're selling stocks or mutual funds in a brokerage account, or if you sell property, those are capital gains. Non-qualified annuities, rentals, rental properties, unless you are a real estate agent this is your main business. If it's just I have a rental property and I do something else, that's considered passive income. And then royalties, and whatever else falls into that IRS category of passive income. Now, it's good to understand too that we're talking about like net passive income, right? So, for instance, if you had a rental, that's considered passive income, but you're looking at net, right? So after the expenses and whatever else, nets out, what is your total passive income for the year? So I mentioned properties there, right? Because capital gains does apply to selling properties. This is true if you have a rental property, but it's also true if you have your own personal residence, right? Your primary residence is subject to capital gains tax. Now, there is that exemption, right? $250,000 for single, $500,000 for married. If you sell your primary residence, and there's certain rules and requirements you need to meet, you have to live there 2 out of the last 5 years, yada, yada, yada. But you can apply this exemption, okay? And that reduces the amount of capital gains from the sale of your primary residence. But anything over that exemption would be included in NIIT, the net investment income tax. Okay, so when is this triggered? It depends on the income threshold, which depends on the filing status, right? Whether that's married filing jointly, married filing single, head of household, right? All those filing statuses there. So pretty much you can think of it as it takes your adjusted gross income from your tax return, your AGI, which you can find on your tax return, and it add backs certain foreign earned income adjustments. Okay, and most of us I would guess the majority of us don't have any foreign earned income adjustments, right? So it'll likely just be your AGI for most people. And then there's these threshold brackets, right, of when you'll be subject to NIIT. Now, these brackets are not indexed for inflation. Okay, they don't increase year over year. They were set and they stay there. And that's significant because as, inflation and people's wages start to increase, right? I mean, more people will fall into these brackets and be subject to, net investment income tax, right? They'll go over this threshold because they're not adjusting up. Okay, so now we get into the thresholds themselves, okay? I'm not going to go into all of them, but married filing jointly is $250,000, okay? So what I'm talking about here is if your modified adjusted gross income for NIIT, which we talked about will be your adjusted gross income for most people, is above this $250,000, then you are subject to the net investment income tax on passive income. Now, there is another step there about how it's calculated, and we'll get into that. But as far as the thresholds are concerned, married filing jointly, $250,000. Married filing single, $125,000, right? So if your AGI, or it should be your modified adjusted gross income, but like I said, it's going to be AGI for most people, is below these thresholds, you don't have to worry about NIIT, okay? It's only if you pass these thresholds. Now, it's a cliff, right? So if you're $1 over, then you are now subject to net investment, the net investment income tax, okay, NIIT. If you really want to get in the weeds, you can look at Form 8960. Okay, that's the IRS form. It has all the detailed info. That's where it's going to be computated on your tax return. And it ultimately, like everything else, makes its way to the 1040 for taxes. One important note for taxes, as it relates to NIIT here, is if you're going to incur a lot of net investment income tax from this extra 3.8% on passive income, you may want to consider withholding additional estimated taxes, right? Because if you weren't accounting for this and you end up with an extra 3.8% on, let's say it's, you sold a big rental property, whatever it is, to avoid underpayment penalties, you still would have to make these estimated tax payments, okay? Okay, so again, going into the calculation and an example of NIIT, right? And this is the most important thing to remember, in my opinion, if you are subject to NIIT. It's the lesser of, right? The amount that you are over the threshold, your AGI, I keep saying AGI, but it's your modified adjusted gross income. Your MAGI is over the threshold, the lesser of that, or the amount of passive investment income. Okay, whatever is less, that's what you're going to pay the NIIT on. And I think the best way to kind of get this across is to do an example, okay? So let's say we have a married filing jointly couple. Okay, we know the threshold there is $250,000. Let's say their modified adjusted gross income is $275,000. Okay, they are $25,000 over that threshold. And they have passive investment income of $40,000 for the year. Well, the lesser of those two is the $25,000 they are over the threshold. $25,000 is less than their passive investment income of $40,000. So they're going to be subject to NIIT because they're over the threshold, and they're going to pay 3.8% on the lesser of, which is just that $25,000 over the threshold, right? Because it's less than their passive investment income. Okay, let's do another example. Same thing. Married filing jointly couple, they have $275,000 is their modified adjusted gross income. Again, same thing. They're $25,000 over that threshold, right? But now let's look at it and say they have passive investment income. Instead of $40,000, they only have $20,000. And remember, it's the lesser of the two. So the $20,000 of passive investment income is lower than the $25,000 that their modified adjusted gross income is over the threshold. So they're only going to pay the 3.8% on the $20,000 of passive investment income because it's the lesser of the two. So it's either the amount you're over the threshold or the passive investment income. Whatever is lower, that's what you're going to get slapped with that extra 3.8% tax there. So why is this important? Well, obviously it's an extra 3.8% tax, right? It's important to understand if you're doing any like big decisions, right? And I always think of properties when I do this, but I guess it could be liquidating, other investment assets, whether that's in the stock market or whatever. It's important to understand this is coming. One, because like I said before about estimated taxes, so you don't pay any penalties on underpayment. But two, so you're looking out for it so you just don't get blindsided by it, right? And maybe there's some strategies that you're working with that are have you hovering around this threshold that you might want to consider, right? Maybe you were considering a Roth conversion for the year, or you noticed, I'm going to get a big, bonus or something in my wages is going up, and this will push us over the threshold. Well, now for any passive income, you can start to think of, okay, that's going to trigger this extra 3.8% on the lesser of the amount I'm over the threshold or the passive investment income. In the end, I don't see this as an end of the world, issue. Obviously, nobody wants to pay an extra 3.8% on whatever amount that is. But, most times the decisions we make financially hopefully have more of a reason behind it than avoiding this 3.8%. And what I mean by that is you often hear is don't let the tax tail wag the dog, right? If you try to avoid NIIT at all costs, that might not be the right decision, right? There's some things you might want to do. Maybe those Roth conversions that'll now make you subject to NIIT have a greater impact on your overall tax strategy long-term or possibly short-term, that the NIIT becomes, insignificant, right? It's just a matter of fact, right? So in the end, it's something to consider, something to be aware of, but I don't think it's the end of the world, and it shouldn't be avoided at all costs. But there are those situations where it might make sense, like, oh, you know what? I can see how this is going to make me trigger this extra NIIT or, whatever it might be, so you can maybe do some positioning around that. Okay, hope that makes sense. That's NIIT, net investment income tax. As always, if there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.